Welcome to the Deep Dive. We're the show that boils down complex financial research, gets to the core insights, and brings them straight to you. Today, we're diving into something huge, kind of hidden. The massive system, often called shadow banking. You know, when most of us think about banking, we picture the traditional banks, right?
Yeah.
The ones that are heavily regulated, take your deposits, which are insured, and, really importantly, they can go to the central bank if there's a major crisis. But a huge amount of lending, maybe even most of it now, actually happens outside that safety net in this shadow system.
That's exactly right. And when we talk about shadow banks, the more formal term is non-bank financial intermediaries, or NBFIs. We're talking about a really diverse bunch of players. They do core banking stuff,
Yeah.
like maturity transformation, providing liquidity, but they do it without the usual regulatory oversight.
Yeah.
No deposit insurance, no direct line to the central bank's emergency funds.
And this isn't some tiny niche, is it?
Oh, not at all. It's vast and varied. You've got massive hedge funds in there, private equity firms, specialized lenders like maybe mortgage companies, big insurance companies, and also these really complex structures like CLOs, collateralized loan obligations. It's a whole ecosystem.
Okay, so this shift creates a kind of paradox, doesn't it? On one hand, you get more efficiency because these players are often highly specialized, really good at their specific thing.
Definitely.
But if they're acting like banks, borrowing short-term money to fund longer-term assets, aren't they just doing banking by another name? And that means they're potentially vulnerable to the same old problems like panics and runs.
That's the core issue. Exactly. The risk hasn't magically disappeared. It's just moved. It's been relocated outside that regulated perimeter.
Where it's harder to see.
Harder to see, potentially harder to control, and crucially, it can still become systemic. It can still threaten the whole system.
Okay, right. Let's unpack all of this then. Our mission for this deep dive is really to figure out why. Why did this huge structural shift happen? Was it just innovation taking its course, or was something forcing it? And then, what are the consequences? For financial stability overall, and maybe just as importantly, what does it mean for you, the consumer? Let's maybe start with the push factors. What was it that made the traditional banks kind of willingly, or maybe unwillingly, push billions in loans and activities out towards these non-banks?
Well, the biggest engine really was regulation, especially after the global financial crisis. Regulators, they significantly increased capital requirements for banks. Think Basel III. And this basically forced banks to manage their balance sheets much, much more aggressively. They had to maximize the return on the capital they were allowed to hold.
Okay. So it wasn't just about chasing profits. It was also about minimizing what the regulators considered risk to make their capital go further.
Precisely. And the research shows a pretty direct link here. You see banks that had weaker regulatory capital, meaning a lower Tier 1 capital ratio relative to their risk-weighted assets, or RWA. Those banks were far more likely to cut back on the loans they held on to themselves. Instead, they'd sell off shares of those loans into the secondary market.
Trying to shrink that RWA number on their books.
Exactly, to meet those stricter capital ratios.
And I imagine this pressure to sell was even stronger for the assets regulators didn't like as much, the riskier stuff.
Absolutely. The effect is much stronger for loans that carry higher regulatory risk weights, so things like non-performing loans or loans rated as fail. Getting those off the balance sheet gave banks an immediate boost to those crucial capital ratios.
And you can really see the impact of this regulatory push in the market for syndicated loans, right? The big loans for large companies.
Oh, the shift there is just stunning. Non-bank funding in that market, we're talking syndicated term loans, it just skyrocketed. It went from maybe 20% back in the early 90s, like 1993, to around 70% by 2014. A huge change. 70%. Wow.
And the dominant buyer that stepped into that gap, it was the CLO, collateralized loan obligations.
Okay, let's pause on CLOs for a second, because they
Okay.
seem central here. We hear the term, we know they're complicated, but just for our listeners, what fundamentally do they do?
Yeah, good question. Think of a CLO as sort of a financial repackaging machine. A firm gathers up hundreds of these big corporate loans. These are long-term assets, remember. Then it slices this pool of loans into different layers or tranches, each with a different level of risk. And then it sells these tranches off as securities, often to big institutions like pension funds or insurance companies. So it takes loans banks don't want to hold anymore and turns them into something other investors do want to buy.
Exactly. It creates a market.
Mhm.
And CLOs basically became the single biggest non-bank investor class in these loans, really taking off after 2002.
Okay, so regulation was the big push, forcing assets out of the banks. But you mentioned earlier, it wasn't just defensive. Technology also played a role. right? A positive pull factor,
Hmm.
making shadow banks maybe more efficient.
Absolutely. That's where fintech really enters the picture. These newer tech-driven shadow banks could use advanced data science, new ways of pricing loans, um, to target very specific markets, often high-quality markets that maybe the big traditional banks with their older systems and broader focus kind of overlooked.
Right. The classic example people talk about is SoFi, right? Going after the Henrys, high earners, not rich yet.
Exactly, that kind of niche targeting. They figured they could assess and price the risk for that specific group more accurately, more efficiently than a traditional bank that serves everyone.
So if we try to weigh these factors, regulation versus tech.
Well, the studies suggest that, at least in mortgage lending, regulation accounts for maybe two-thirds of the shadow bank market share growth. Technology, the efficiency gains account for roughly the other third.
So tech enabled it, made it possible, but the regulatory pressure was the bigger initial shove.
That seems to be the story, yes.
Yeah.
The regulatory friction provided the main impetus.
And this wasn't just mortgages. We saw similar growth in corporate lending too, right? Through things like private credit funds, BDCs, business development companies.
Yes, their growth has been remarkable too, and a key part of that was their funding costs becoming more competitive. Before the GFC, a BDC's cost of capital, basically how much it cost them to raise money to lend out, it was maybe 200 basis points, that's 2% higher than a bank's, which meant banks usually had the edge.
But that changed.
Yeah, post 2010, that gap pretty much closed, converged completely. BDCs suddenly became much more competitive funders, partly because their cost of equity came down and partly because they were allowed to use more leverage.
Okay, this is where it gets, for me, really fascinating.
Hmm.
Because this leads to this interdependence, this kind of tangled relationship.
Yeah.
The traditional banks didn't just wave goodbye to these assets and competitors.
No, far from it.
They actually ended up funding them. They became the upstream financiers for the very non-banks competing with them downstream.
It's a crucial part of the structure. This connection often happens through something called warehouse lending.
Warehouse lending. Okay, what's that?
So imagine a non-bank mortgage company. They're writing new mortgages every day, but they need short-term cash, like bridge financing, to cover those loans until they can bundle them up into a mortgage-backed security and sell it off.
Right.
That vital short-term funding, that's the warehouse line. And guess who provides most of those lines?
The big traditional banks.
Overwhelmingly, yes. The large banks provide the funding that allows the non-banks to originate loans in the first place.
That seems like a paradox. The banks are bankrolling the competition. That's taking their customers, taking their market share and things like mortgages. So did this structure at least lead to more competition for us, for the average person trying to get a mortgage?
Well, unfortunately, the evidence suggests no, not really. It looks like the banks are using this upstream power, this control over warehouse funding, pretty strategically, and it might actually be hurting consumers.
Yeah.
Okay, so the research finds that banks are less likely to provide that warehouse funding to a shadow bank in a specific area, let's say a county, if the bank itself already has a big slice of the mortgage market there.
Ah, so they're protecting their own turf, trying not to fuel direct competition where they're strong.
Seems like it. They're actively trying to avoid, cannibalizing their own profitable business.
Okay, that makes a certain kind of business sense, I suppose. But what about when they do decide to fund a shadow bank competitor?
That's the other side of the coin. When they do provide that funding, the data suggests that mortgage rates for consumers in that downstream market tend to be higher.
Higher, even with a new competitor funded.
Yeah. It suggests the banks aren't really funding these shadow banks to boost competition and drive prices down. Instead, it looks like they're extracting rents, like extra profits, from their powerful position in the upstream funding market. They control the capital flow.
So they profit from controlling the funding, even if they don't make the final loan. And you mentioned this has a real cost to the public. Can we quantify that?
The models used in the research are pretty stark. They estimate that this upstream market power, this control over funding, actually dampens competition in the mortgage market enough to reduce consumer surplus by about $14 billion.
$14 billion.
In an average metropolitan area.
Just to clarify for listeners, when we say consumer surplus loss, that $14 billion didn't just vanish. What does that mean in practice? Higher rates, less access,
It means both, essentially. Consumers end up paying higher interest rates on their mortgages than they likely would in a truly competitive market. And it also means that some borrowers, maybe on the margin, who could have qualified for a loan at a better price or perhaps needed slightly more flexible terms, might have found it harder to get credit at all. Access gets limited.
And this effect is worse in some places.
Yes, that cost nearly doubles in metro areas where the mortgage market was already highly concentrated, where there were fewer lenders to begin with. So the borrowers who arguably need competition the most are the ones who suffer the biggest impact from this structure.
So this whole system, this reliance on big banks for the initial funding, didn't really foster competition. It just sort of allowed the big banks to maintain control, pull profits from the supply chain, even when they weren't the ones facing the customer directly.
That seems to be a major part of the story. And speaking of big banks, they utterly dominate this whole funding relationship.
Really? How much?
Well, the research indicates that the very largest banks, just those in the top quartile by asset size, they account for something like 99.5% of all the intermediation of this shadow bank debt.
Wow. Over 99.5%.
It's incredibly concentrated. This isn't some decentralized, diverse funding system. It's highly reliant on a few huge players, which brings us neatly back to the issue of fragility.
Right. That concentration, plus the nature of shadow banking itself.
Uh-huh.
Performing maturity transformation, borrowing short to lend long, but without those traditional safety nets. What makes them structurally so fragile?
Well, their fundamental weakness is that maturity mismatch combined with their funding sources. They depend heavily on short-term wholesale funding, not stable insured deposits. Things like repurchase agreements, repos, or shares in money market funds that promise a constant net asset value.
Can you quickly break down why those funding sources are considered fragile?
Sure, repos are essentially very short-term secured loans, often just overnight. If the entity lending the money suddenly gets nervous about the borrower, they just don't renew the loan the next day. Funding vanishes instantly.
Okay.
And those constant NAV shares in money market funds, they try to keep a stable $1 share price. But if investors worry the fund might break the buck, lose value, they will pull their money out en masse immediately. It's a recipe for a wholesale funding run.
So it feels like we regulated away the risk of runs on insured deposits at banks, only to see this system shift towards entities funded by things vulnerable to these older, faster, potentially more contagious wholesale market runs.
That's a very good way to put it. And we saw this fragility act as an amplifier during the 2008 crisis. The research looked at loans funded by different types of non-banks. Those funded by non-banks using unstable liabilities, think hedge funds, private equity relying on that short-term wholesale funding. Those loans saw their prices fall much more sharply during the crisis.
How much more sharply?
We're talking about an 8 percentage point difference, a spread, compared to similar loans funded by non-banks with more stable liabilities like insurance companies or pension funds with longer-term funding. Credit availability also dried up much faster for those relying on fragile funding.
An 8 percentage point price gap in a crisis? That's huge. It really confirms that when risk moves to these less regulated entities, their funding structure can actually make shocks worse, amplify them through the system.
It absolutely can. Now, here's a slightly counterintuitive point that often comes up. Many shadow banks, if you just look at their balance sheets, actually look better capitalized than traditional banks.
Really? How so?
Well, on average, studies find shadow banks might have an equity to assets ratio of maybe 18% to 20%, whereas traditional regulated banks are often more in the 10% to 15% range.
Wait a minute. If they have more capital, nearly double in some cases, isn't that safer? Why are we still talking about fragility and uninsured leverage being the key problem?
Yeah, it seems odd, but that's the critical distinction. That higher capital ratio in shadow banks, it's supporting leverage that is almost entirely uninsured. There's no government backstop like deposit insurance. It's the market, and only the market, that disciplines that leverage. And what the data shows is that this reliance on uninsured debt tends to grow significantly as these institutions get bigger. The larger the shadow bank, the more it leans on potentially runnable uninsured funding.
That pattern.
Yeah.
That sounds really familiar. Depressingly familiar.
It should, because it mirrors how the banking system worked before the FDIC, before deposit insurance. Those pre-FDIC banks also often had higher capital ratios on paper than modern banks, but their leverage increased sharply with size and was totally uninsured, which is exactly why the system was so prone to contagious bank runs and regional panics back then. Shadow banking, in some ways, is recreating the very vulnerabilities the safety net was designed to prevent.
Okay, so let's try to pull this all together. What does it all mean? We've seen this dramatic shift in the financial system. driven partly by necessary regulation on the banks
Hmm.
and partly by genuine innovation and efficiency from these new players.
Right. The key takeaway, I think, is that while shadow banking has brought certain benefits, efficiency, specialization, maybe more choice in some areas, it hasn't eliminated systemic risk. Its deep connections back to the traditional banking system, combined with its own funding fragilities, mean the risks have just been relocated. They're maybe less visible day to day, but they can be amplified significantly when markets get stressed. The core banking functions are still happening, just often by entities less equipped to handle a crisis.
So the policy debate really needs to evolve, doesn't it? Maybe less about whether shadow banking should exist and more about how we regulate the risky activities themselves, regardless of who's doing them.
Exactly. That's where the conversation is heading. If securitization, for example, has bank-like run risks, maybe we need to regulate that function consistently. You see proposals out there, for instance, exploring things like narrow funding banks or NFBs. These would be specially chartered entities designed to handle key securitization functions, but they'd be under the regulatory umbrella, potentially needing capital and having access to emergency liquidity.
But the fundamental challenge remains, right? How do you keep the benefits, the innovation, the specialized expertise you get from, say, a dedicated private credit fund? How do you keep that without exposing the whole economy to the dangers of unregulated, fragile leverage and that classic maturity mismatch?
That's the tightrope walk. The growth of this market-based finance just constantly highlights that tension. The tension between chasing efficiency and economic growth and maintaining financial resilience. We seem to keep rediscovering that the old risks of panics can follow innovation very closely.
So maybe a final thought for you, our listener, to chew on. If the market keeps finding clever ways to move activity just outside the latest regulatory lines, are new rules just shifting where the risk is hidden? Or can we actually design a system that's truly resilient, one that can actually contain a run on this money by another name?